Hi, this is Michael Carlin, president of Henry Horn Wealth Management, and we are here with your fourth quarter quarterly market outlook. As always, we're going to be doing this one slide at a time, trying to go through the data, find out what's real, what's not real, and where we're going. Hey, Stefan.
Hello, Michael.
How you doing?
Very happy to be here. I'm really great. Doing just great. How are you?
I'm pretty good. Today's my birthday.
You admitted it. Wow.
I did.
I wasn't going to bring it up.
Well, when you looked at me and you said, "Well, how you doing?" and that was what came to mind. So today's the birthday, and in the spirit of celebrating things, we are celebrating this closure. This is going to be the last of the 2018 market outlooks, and we finished. This is going to be finishing a year for us. This is exciting.
The fourth of the series of 4.
That's it.
And I think we've improved as we've gone along.
For sure.
Our technology's getting better.
Yeah.
Yeah.
Slides are still awesome. Although this quarter we got a lot of good data. Ton of great slides.
We have terrific data. We've got, for those of you listening, you would be amazed at the research team that we have behind us. Multiple research teams. We see just incredible data, week in, week out, day in, day out. You can't keep up with all of it.
Right.
Yeah.
We try. So rather than talk about it, can we do it?
Yes.
Let's go through it.
Please.
Let's see. One of the things that we saw early, there was a cover of Fortune magazine and a cover of Barron's. Those two covers stand out to us because on the cover of Fortune, it's a guy screaming, wearing a sign, "The end is near," in a business suit. In the Barron's article, it says "The Bull's final countdown" with a raw piece of steak on the cover. But both of the covers saying the same thing, that don't get too excited about the market because it's over. And what I see, what you see, what we see, what clients are seeing is we're seeing the fear is becoming more palpable for the first time in really a long time. As of right now, in October, as we're looking to close out the rest of the year.
The media has to sell magazines and commercials. They've got to get your attention. I think the Barron's piece of beef you're talking about is interesting. It says "best diffused by 2020."
Right.
And we had a client in the office just last week who said that he felt that the bull market was going to continue until 2019 or 2020. And we have a sort of like a crystal ball. It's colored that sits on the desk that many of you have seen, and I picked it up and looked in it to figure out if that 2020 was
if it was in the crystal ball.
If it was in the crystal ball, yeah. But the media, I think, encourages specific dates. They like as if they know what's coming in the future. We don't know what's coming in the future, but they do have people stirred up.
And I would encourage you all to, if you've got your phone handy, Google, the death of equities cover. You're going to see that throughout history, it's decade after decade, Fortune, Money Magazine, you name it, they're all predicting the end of the market. And that is really, as Stefan said, just to indicate how are we going to get people to buy our magazine. And if you look at the real market results in coordination with covers of magazines, they're almost opposite.
Right.
So don't take your financial advice from the cover of a magazine. Don't. And that leads me to the fact that this market that we're in right now may be one of the least loved bull markets of all time. And one way that let's peel back some of the data. One way I want to look at it is, where's money going? And if you look at mutual funds and index funds for U.S. stocks, it's rather shocking because there has been a flight towards passive index funds and a flight out of actively managed mutual funds virtually every year since 2009.
That's right.
Shocking.
Yeah.
And we're trying to figure out, again, where does the money go? And we're seeing, again, passive is pulling in a fair amount of domestic dollars, U.S. dollars, passive index funds. But yet again, the inflows are not overwhelmingly high. And as you're looking to see where some of that money's going, it stands out. And we'll talk a little bit more about this. The money is flowing into bonds and bond funds.
Bonds and bond funds. And you're seeing it move out of domestic mutual funds and into domestic ETFs.
Yeah.
But the flows out of the mutual funds are far greater than into the equity ETFs.
Right.
And the real funds, the flows are moving into the bond funds. And you also see some movement into mutual funds and ETFs for international equities.
Yes.
And that's
interesting how they both active and passive international attracting money.
Attracting money and has been since 2009, even though you've seen some real underperformance a lot of that period. There was some outperformance in 2017, but 16 and 15 you saw underperformance, and then this year you're seeing dramatic underperformance again, even though the money continues to move international.
Right.
Yeah.
So another inference not to draw if you're an investor. Don't look at the cover of magazines and don't look to see necessarily whether money's going into the U.S. market or international to determine where you should be putting your money. You got to have a whole lot of other data points to look at. So let's go ahead and dive in, because again, just one quick thing is that all that money piling into bond funds was done before rates appreciably rose.
Right.
Meaning, all that money flowing in there has lost a significant amount of value.
Right.
So to follow the dollars doesn't always give you the greatest indication of where to put your money moving forward either.
Absolutely. Absolutely right. I think a lot of people, the global financial crisis affected a lot of people dramatically, and people have a tendency to look through the rearview mirror when they're trying to anticipate what the markets are going to do. And as this bull market in stocks has continued to run, I think a lot of people are still worried about what happened in the financial crisis. They can still see that in the rearview mirror.
They do. We hear about it with our clients all the time, and we're looking at the length and duration of this bull market run, and it's stunning.
It's amazing.
It is now longest bull market run in stock market history. We're right there again, that big .com bubble decade that we had, where stock prices reached valuations no one had ever considered. And it's interesting because if you're looking at the total length, we've matched it. But if you're looking at how much the market has appreciated, the only bull market run that's been better has been that .com bubble bursting. And it's hard for me as an advisor to imagine us getting back to those outlandish valuations that just didn't make sense.
Right.
I do want to say this one thing before I move on to the next slide. And I remember as an advisor in the late 90s, there were endless stories that I was reading from different publications, from Merrill Lynch or from Morgan Stanley, that were saying this time's different. And you could buy Microsoft and Cisco at any price, because look at what's happening with the economy and the way the world is going. And these prices make sense because here's how much money they're going to make in the future. And it all seemed, for a moment, very rational. Until only in looking back, you realize how irrational it was. And it starts to feel a little bit, I start to feel it a little bit where they say, it doesn't matter what Amazon does. It's the future of this. It's happening with there. And I start to feel that sense of irrationality. Now, I'm not trying to compare Amazon to some of the other .com stocks, but I am saying the stories are feeling similar.
Yeah, absolutely. And you hear people trying to justify very high valuations with stories that may or may not be right, may or may not make sense, and talking about it could be different. And just for grounding, that 1990 to 2000 bull market ran for 10 years.
Yeah. And
it ran up on the order of 425%. That was a heck of a bull market.
Yeah.
The average bull market that we've seen since 1928 has been 57 months.
Right.
So about half of the 120-month longest, and has ran up about 165%, so 1.65 times. It's a pretty good run. This one now is over 120 months, and is on the order of 330, 340%. So it's the longest one. and the second highest move, second strongest move. It's just going on and on and on and on.
And I don't think we have a problem with the fact that it's gone up a lot, because the market went down a lot beforehand. So there does need to be an extra atonement. There's got to be an extra push higher, but it's starting to get in the degree to which we're gonna again continue to look through the data to figure out when is enough. And the market made a new high since our last call, which is exciting and interesting, because historically when the market makes a new high 8 months after making its old new high,
right,
it's historically a bullish sign of the market running higher. And if you look at it, that as soon as you reach that new high, historically speaking, there's another 10% run on top of the market move that you just saw, and that creates a little bit of confusion, because on one hand we have valuations, we have the length and duration, but we just made this new high, which again, historically speaking, is a sign of good things to come.
Well, it is, and sort of boring finance stuff. There's what they call beta, which is the market return, and then there are anomalies where you get outperformance relative to the market return, and the two biggest ones are value, which means you buy stuff cheap, and momentum, which is this strange experience where things that are trending upward tend to continue to trend upward,
right,
whether it's an individual stock or a stock market. And we see these 52-week highs, especially after an 8-month period without one. More often than not, a year later, you're going to be higher than where you were before.
Right.
Yeah, it's a really bullish signal.
So don't sell your stocks quite yet. And the question starts to be is, can we run higher? And we're seeing some signs where if you compare this market run to the last 4 market runs before we had a significant sell-off, the way this market is trading, reaching higher highs, and you see a little bit some head fakes and market downturns, it's eerily similar to some other prior markets like the one of 2010, 11, 12, and 15, where we got 10% plus corrections. We're starting to see some similarities, which would be indicative of sometime maybe in the month of November, we might see the market pull back temporarily. So we have this conflicting report. We've got some data that suggests market high, market moving 10%. We've got other data that suggests we may be now at this point a month and a half away from the market reaching its crescendo, and maybe we do go up another few percentage points between now and then. It's interesting as you parse through it, and I think what you'll find, listeners, as you hear us go through this, is we're going to help you draw definitive conclusions as we introduce all of this data between now and the end of the podcast.
There are a lot of mixed signals, but we want to provide clear guidance. I was doing a talk 2 weeks ago, and at the beginning of the talk, somebody in the audience said, "Are you gonna scare me or excite me?"
Right.
And I said, "Well, I'm going to show you some interesting things on both sides, and you'll tell me more about your predisposition,
right,
to what I say than what I'm going to say."
Yeah.
Right.
It's well, because people's predisposition does matter in terms of how you allocate portfolios. And one of the things I'd like to point out is that one of the things we look at is the Federal Reserve real Fed funds rate. Again, Fed fund rate is the short-term borrowing rate that the Fed has. And for a long time, when the Fed borrowing rate was at 0 and you had inflation on top of it, the real rate was negative. It was less than 0. Now we are 2% on the Fed funds rate. And so inflation is, depending upon the particular quarter, right around that number. But we're starting to see where there's a very likely going to be a positive real Fed funds rate somewhere between 0 to 2%. Historically speaking, since 1960, the market rate of return has been only 4.3% when you have a real Fed funds rate between 0 to 2. And we know because the Fed's going to be increasing interest rates very likely in December and perhaps another couple times if what Chairman Powell says is accurate in 2019. They're going to increase rates on the short side. It should be higher than our inflation rate, which puts us squarely in this bucket, which is again, that 0 to 2 number, you see a 4.3% average rate of return, and compared to having a real inflation rate, real Fed funds rate of 2 to 4% or less than 0, your market rate of return is less than half.
Yeah.
Is less than half of what you'd expect at 4.3%, which is challenging.
Right.
And to me, it feels like that's the kind of data where it starts to make sense. And that if you couple that with how far the market's run and the magnitude with which it's run, and the fact that we're in this new period where the Fed's raising rates and we have to deal with higher costs and higher wages, it starts to make sense that it's going to have an impact on market returns. And there's a story even this morning that I read, and the data points indicate that we should be seeing more market volatility here and for the next couple of months, quarters, or who knows how long.
Right.
This is what happens when the Fed starts raising rates and it starts to hurt.
Absolutely. And there's the sort of the narrative economics. Everybody knows when rates start to rise that it can affect equities. Right. On the other hand, we all know that rising rates means a strong economy.
Yeah.
So we're looking ahead. We see a really strong economy, but the cost of money is rising.
Right. And you talk about the economy being strong, and we've got the same bull market checklist that other firms do. And if you want to take a look at it, we're happy to send it. But what it shows you is that if you look at the data points right now, a lot of them still, at this moment, indicate the bull market should have a little bit more energy to run forward.
Right.
If you look at data like how's the consumer doing, if you're looking at the personal savings rate, I see good numbers there. If you're looking at consumer confidence, I see phenomenal, best ever figures for consumer confidence. Again, if we're still a consumption-based economy, a confident consumer is a consumer that spends money. That's something that's going to move us forward. That looks good too.
It does. It looks great. And we didn't talk about it before, but the ISM survey, which is one of the best indicators I've ever seen to mirror the business cycle,
right,
is at all-time highs. Mm-hmm. It is just very, very high. And typically when that ISM survey is high, the stock market continues to go up.
Right.
And it's very high. So you've got confidence and reason to have confidence. Mm-hmm. Things look really strong in the economy.
Absolutely. And two of the things academically, two areas of the market academically that we continue to think that there are some opportunities there for growth would be small caps and global. And for a few reasons. I mean, one, and the biggest one is being valuation, is that we don't like paying a lot for companies if we don't have to. Certainly if there's other areas of the market we can grab that growth opportunity at a lesser premium. And if you look at things like small caps, what's interesting is that in 2011 and 2013, small cap stocks had two significant corrections of in 2011, 30%, in 2015,
yeah,
right?
15, yeah.
Was minus 27%.
Nearly 30% again.
Right. So some say, well, geez, we've already had a reset in small caps. So yeah, I understand large cap blue chip stocks haven't gone down and had that reset button, but maybe small caps have.
Right.
And when you couple that with better valuations, a U.S. first fiscal policy from Capitol Hill, you start to think, well, maybe there is some fundamentals behind small cap and maybe even mid cap to the same degree where large cap might be a little extended.
Yeah, that's exactly right. And the small caps typically are a lot more volatile than the large caps. So if you want to take advantage of potentially better valuation, you got to be willing to hang on and ride the ride, because it can get a little bit bumpy, although it will probably outperform over time. You mentioned value, the same thing there. If we can find good values, we want to do that. The data shows that over a long period of time, value outperforms the market dramatically.
Yeah.
The best value investor, Warren Buffett, everybody knows him. but you can underperform in value for 10 years.
Right.
In fact, there was a 10-year window where Buffett himself underperformed the S&P 500 for 7 of 10 years.
Right.
But over the 10-year period, he outperformed 4% per year.
Right.
So the 3 years that he outperformed were so
Massive.
dramatic, but you got to be able to ride through it if you're going to play the game that way.
And I think that's something where we see that a lot, where investors fall in love with their prior returns if they were good, or if the prior returns weren't great, then there's just a disconnect. There must be something wrong. But that's just not always the way that things work. They don't work linearly. They don't always routinely stay the same. They're not always. There is some variability to how you're going to earn rates of return.
Yes,
right.
yes. So my wife says when I talk about financial things, she calls it boring financial stuff, and she tunes out and rolls her eyes and goes and does something else.
Are we dangerously approaching that?
Well, what I was going to say is a lot of listeners may think that this is awful, boring financial stuff, but there's a term in statistics called ergodic, which means
here you go.
Which means a cycle will be repeating equally cycle, and the assumption that almost every investor makes without realizing it is that every cycle is going to be the same.
Right.
And the truth is, we don't know whether a 5-year cycle will repeat, or a 10-year cycle, or a 20 or 100-year or a 200-year cycle. We don't know what's coming.
We don't.
Yeah,
we don't. And we just, again, we're trying to navigate and read the tea leaves. And I mentioned small cap reset twice.
Yeah.
Between 2014, the middle of it, and 2016, look across the world.
Yeah.
There were markets, again, Shanghai, the Chinese market down just about 50%, or European, their equivalent S&P 500 in Europe down 27%.
Yeah.
Japan down 30%. There was also a reset that happened not just to small caps here in the U.S., but also overseas. So again, many think we talked about, the length and duration of this rally. But wait, haven't there been resets in other places? And the answer is yes, there has, which give those that have this bullish case for stocks to continue to run some fuel to say, no, there have been parts of the world that have reset, so we should have some more room to run here. Yeah.
You've got Greece down now in a drawdown on the order of 90+%.
Right.
You've got Russia in a drawdown now in the 60-something
like that,
percent.
Yeah. Mm-hmm.
And but you got to wonder, is that a value trap? Is it are they going to keep going down, or at what point do you jump in? But significant resets. Mm-hmm. If you look at, as we do every week, a chart of U.S. performance compared to the rest of the world equity performance, compared to emerging market performance, you see a stark, dramatic contradiction right now, where globally things are going down, the emerging markets going down in equities, but the U.S. Going up. Yeah. Interesting to see the dichotomy.
It didn't used to be that way. It used to be something like, if China sneezes, then the U.S., do they catch the cold? Those are the kinds of things that you'd worry about. And now and we'll talk a little bit more about it, the Chinese market down significantly. To your point, it's amazing that we haven't seen it here. And part of it is maybe central banks. We've got a great chart that lays out all the major central banks across the world, so that you can get a sense for their total activities. It's got like the Federal Reserve, you see QE1 and QE2, QE3, their total balance sheet movement, right? And then you're also seeing with the Federal Reserve, really for the past, certainly year to date, the Federal Reserve balance sheet's been shrinking to the tune of about $100 billion plus per month. And you look at Bank of England, you're looking at the Bank of Japan or European Central Bank, those lending institutions continue to expand their balance sheets while we don't. It didn't used to be that way.
We've talked about this all year long, what's going on with the global central banks. It may be the most important factor in what's going to come. We don't know for sure. But to simplify, why do we care so much about that? When there's more money in the economy, chasing the same amount of goods and services in the forms of stocks, then the prices for those stocks go up. When the central banks started taking money out of the economy, there's less money chasing those same goods and services in the form of stocks, and that can cause them to go down. So it's interesting to see here how the major central banks across the world continue to inflate, continue to add capital, and continue to put the punch bowl out,
right,
whereas the Fed seems to be taking it away a little bit.
And the Fed, if you look at these charts, the Fed leads the world in this kind of activity.
Oh, yeah.
And so is it another sign and symbol that maybe the punch bowl will be pulled back, not just here in the United States, but worldwide? And what does that mean? And one of the impacts that we see is with interest rates. And if you look at let's talk about the 10-year Treasury for a moment. 10-year Treasury had a major, monumental move here recently.
Last week, big week.
It finally broke through resistance. It's been struggling to hit 3% and stay above it. It's now hit it, stayed above it, and it's reached a new milestone. We're at the 3.15, 3.2 range.
Right.
And it's interesting because now many expect it to continue to accelerate higher from here. The 30-year U.S. Treasury also went significantly higher as well. It made many relax to some degree because we're all been so worried about this inverted yield curve, in that can the long rates get higher, because we know the short rates are getting higher. Chairman Powell's increasing them. And it was exciting to many to say, oh, geez, no, the whole yield curve was steepening at that time. But I wonder if there's a natural cap on that 10 to 30-year Treasury. And what I mean is that if you look at global interest rates, where we are in the U.S. at the 3+% range on the 10-year, look around the world. Germany at 1.4. I'm sorry, no, Germany's at 0.3. The UK's at 1.4. Japan's at 0.1, and Switzerland's negative 10 basis points.
Negative, if you can believe it.
Right.
Yeah.
You give me your money for 10 years, I'll give you less.
That's right.
Guaranteed.
That's right. Guaranteed.
So,
and that's not even inflation-adjusted negative. We've gotten used to inflation-adjusted negatives in different parts of the world, even here in the United States, but that's a nominal negative, an actual negative.
Yeah. And so it's hard for me to imagine a world where U.S. rates can continue to surge higher, where in the worldwide competition for capital, as we're competing for capital, we're still the highest quality market in the world. And with the rest of the worldwide rates being so low, you would struggle to see how U.S. rates can continue to surge higher from here, because there should be enough worldwide demand to keep those rates low.
Yeah, exactly right. You think if the U.S. has a higher interest rate, money should pour to that higher rate. And as money pours in, that should push the price up.
Right. Price
going up, of course, would mean the yield coming down. So that's your cap that you're talking about. Makes perfect sense.
Well, and so factor that in where you're looking at, again, Fed funds rate and whether we can sustain it, and whether or not the Fed's going to tighten until something breaks. That's the way. There was a great piece in Strategas, one of our data research outfits, that said, the chart says, will the Fed tighten until something breaks? And if you look, going back to 1960, if you're looking at leading economic indicators all bundled together in the same chart, we have hit such historic highs on this leading economic indicator chart where it seems stratospheric. It seems that way. And so what many of the listeners should already know, if you don't, and if you don't know this, you need to, is that the Federal Reserve increasing interest rates will lead to things slowing down. It will lead to the economic activity slowing down. It does lead into market confusion and ultimately, to some degree, market correction. And the question is when. And when you look at the leading economic indicators as a data point, you say, wow, this looks super extended. It's unbelievable.
Right. You see from 1960, continued growth. You see a big move down in the leading indicators before the recession, before the bear market in 2008. And then since then, just a really strong, powerful, direct move up that continues to push forward. And the leading indicators are called leading indicators for a reason.
Right.
They do a pretty good job of telling you what's coming.
Right. So again, so the market expects continued expansion, and in the face of the continued expansion, we have tariff. We've mentioned tariff likely every quarter this year.
You bet. It's one of the big stories.
Yes, and every time Trump announces a new tariff, the market's gone down that same day. And it's interesting, though, is that since the tariffs were announced, our market's appreciably higher. Since tariffs were announced, China's market is down 25% roughly over that same time period. Clearly not able to brush it off the same way that our market is. I think to myself, I wonder what Trump would do if the tariff talk took our market down 25%. I'm sure, or I shouldn't say I'm sure, it would seem likely to me that Trump would say, oops, or if the market dropped that much, no, I'm going to change course. But he's able to be emboldened, and passionately so, about tariffs because we haven't had to price to pay here the way that they have in China.
If you ask yourself who's winning the trade war, and you use as the barometer of the winner of the trade war the stock market in China and the stock market of the United States, then we are clearly winning the trade war. We'll see what happens. It's I don't know if it's the first quarter or the halftime or the third quarter of the trade war, and I'm not going to say who wins the game until it's over. But right now, our market is dramatically outperforming.
Yeah, and it is, and I guess, for the sake of our clients, thank goodness.
Yes.
And again, I just want to touch on real quick the inverted yield curve. I mentioned it. We've mentioned it many times.
Over and over, absolutely.
But you'll notice now when you look at the data, we were so close to being zero, flat, until this most recent surge higher.
Right.
So you may see the data reverse itself a little bit where we didn't quite hit zero. We got to keep watching that to see if the yield curve is indeed going to invert or get to zero. By the way, every time the yield curve has gotten at least zero, it's always gone negative. But again, so we're watching that data. It's improved a little bit.
Yep.
Maybe we'll escape the jaws of defeat. I don't know, but
I think we talked about this before. But I'm fascinated that more often than not, the talk about yield curve inversion is a discussion about recession. Mm-hmm. And recession is important to us as a country, but as investors, we care more about bear markets than recessions in the economy.
Right.
And what you'll see when the yield curve inverts is sometimes the bear market will begin that month. Mm-hmm. One time in 1978, yield curve inverted, bear market started that month.
Right.
In February of 2000, yield curve inverted, bear market started the next month.
Right.
So that's why we are acutely sensitive to that yield curve inversion.
Right. So we're watching.
Yeah.
We're watching. Encourage you to do the same. One of the bright spots, I think we should do some bright spots.
Yes.
Bright spots is money coming back to U.S. soil. They're repatriating the foreign dollars. We had trillions of dollars earned overseas.
Right.
And corporations weren't bringing those dollars back for a variety of reasons, one of which is they'd have to pay a second tax. They pay the tax when they earn it, and they're going to have to pay a tax when they bring it back to the U.S. So they said, forget it, we won't bring it back. In the tax law reform, that was changed. You saw repatriated foreign dollars of we should be expecting for this year $700 billion coming back, sitting on U.S. corporations on U.S. balance sheets here domestically, which would make you wonder, what
are they doing with it?
Yeah.
What are they doing with it?
So there's three different things that we see. CapEx spending, again, capital expenditures, businesses and reinvesting in the business equipment, things like that.
Investments, you bet.
Or maybe share repurchases, buying more shares of their stock to decrease the number of shares, which will make the existing shares left outstanding more valuable, move the stock price higher. Some call that financial engineering. Or it's maybe they're paying it into dividends. Maybe they're paying it to shareholders.
Right.
So if you look, as we see in this chart, dividends have continued to increase, but we've seen this increase sequentially at the same rates that we've been seeing it in the past. It doesn't seem to me that our repatriated foreign dollars are going into that because it's just a continued smooth line.
Right.
Well, share repurchases have spiked significantly.
Big spike.
And capital expenditures have also spiked as well.
Big spike.
We love CapEx, which we'll talk a little bit more about because it's a sign for potentially future growth. And a lot of transaction activity to reduce share count. So, again, if you look at where that money is going, it is coming back. We do see what's happening with it, and it is favorable for stocks, which at least explains in part what we've been seeing.
It does. It also helps explain how we're compensating for the potential damage done to the tariffs because of the tariffs. And I know that listeners, you see this, Michael, you see this, investors and friends in different businesses are being affected by the tariffs.
Yeah.
I hear about it every week. Somehow it's affecting their business. So I think to myself, well, how is it possible that it's not affecting the stock market more? Why is China hurting more than we are? I think part of it has to do with this money coming back like you're talking about.
Yeah.
And it's getting spent. It's that we're buying back shares, pushes up prices, and we're investing the money.
Yeah, and in lower taxes, corporate taxes help too.
That's
a good thing.
That does help.
It does. So if you're looking at capital expenditure plans for publicly traded companies, we've seen continued expected increases in capital expenditures. Again, when we have businesses reinvesting in themselves, that is a great thing, short, medium, and long term. Because we want them growing and doing things to help move the economy forward. That's great. It's great for jobs. It's great for productivity. A whole bunch of different economic measures and real measures too. Yet the rate of expected capital expenditures is slowing. So it's improving, but the rate of improvement is slowing, which is
right.
One of the things that we want to be able to hang our hat on is something like this. Oh, the money's coming in this, and businesses are going to invest, and but we're seeing the rate of improvement slow.
Right.
So we need to be careful of that.
Right. Makes sense.
Couple of other things. Cash.
Amazing what's happened in cash.
You remember, cash used to be zero. Wasn't it zero?
Still, a lot of people are getting zero on their cash in the checking account, but they don't have to.
Yes. Renegotiate, by the way, with the bank. Call us. Call somebody. We there are 2% rates available on cash.
Sure.
Right.
Sure. Fully liquid.
Some people are putting money in CDs.
Fully insured, fully liquid.
Yeah. Right. We don't recommend CDs often. You never know. But there are options out there. And what's changed is that the yield on stocks was so much greater. Just pick the S&P 500. The yield on the S&P 500 was so much greater than what you'd be getting on safe fixed rate investments. You would have investors in droves making the decision, well, I'm going to be investing for the next 5 years. Apple, I'll pick Apple. Apple pays a 2% dividend. At some point in the next 5 years, I think Apple stock will be higher.
Right.
I'm getting zero on my cash. So I may as well buy Apple, get a 2% yield, and hopefully the stock goes up, which, by the way, it worked out great.
Easy decision, worked out well.
Yeah. So there's a lot of S&P 500-based dividend-paying companies that have had that same formula. Geez, the dividend is this. I'm getting nothing on cash. Well, now the yield on cash is greater than the yield on the S&P 500, which gives people choice.
Right.
Uh-oh.
So now they have a choice. Do we look for the dividend from the S&P, or do we take the interest rate off the cash, which is a little bit better, and at the same time have the opportunity to reduce a little bit of risk? You were sort of forced into the risk before, but now you don't have to take the risk if you don't want to, which could draw some capital away from the stock market. People decide, let's take some chips off the table, get the same yield as we can get from the S&P 500, but not have the risk.
Right. And right now, the 2-year Treasury yield in this chart is so far greater than the yield on the S&P 500 dividends. It hasn't been this different, this much higher on the 2-year Treasury versus S&P 500 dividend yield since the financial crisis.
It's been a long time.
Yeah, and I don't want to end by saying, oh, since the financial crisis, let's cut this thing off. but I got to tell you that to me the conclusion is you have to be expecting significant volatility because the Fed's playbook has been very clear. We're going to be raising rates.
They're telling us.
Okay. They want to raise rates because for a variety of reasons. One, and to me, most importantly, they want to have a tool that when the economy does start to slow down, the best and easiest tools for them to cut rates to help push the economy forward. And you can't cut rates if you're already at zero.
No, you can't.
So they needed to have it elevated, which is what they're doing. And they seem laser focused on it. So we're competing with the Fed.
Yeah, well, and the Fed also, part of their mandate has to do with inflation. And the most dangerous type of inflation to big business is what? It's wage inflation,
right.
Of course. And we're starting to see wages start to rise. For those of you who own businesses, you might be finding it's harder to find employees. The labor markets are really tight. Yeah. Unemployment is really low. And those are the kind of setups that can lead to significant wage inflation. The Fed does not want that. So they're wanting to take away the punch bowl, throw on the brakes, make sure we don't get runaway wage inflation, and, just like you said, have some room to ease if they need to when the time is right.
Right. And so expect volatility, because every time you get into a situation like this, the market's more volatile. We're more volatile right now at the beginning of October. Expect it moving forward. The fundamentals of the economy still, as we sit here right now, are still rather strong, right? There's still good capital expenditures for businesses. There's still good fundamentals. There's still good balance sheets. So so that helps. So if you're worried about the risk in your portfolio and you're not one of our clients, call us. We're happy to take a look at what you got and assess your risk.
Email.
Or email?
They can email us if they want to.
Email's good.
What's the email address?
Oh, that's a good one. Well, you would do info@hh-wm.com.
There you go.
Well, listen, I think we did it all.
We did. Happy birthday to you.
Oh, thank you.
One of your daughters had a recent birthday.
She did. Brandon did.
Yeah.
It's a good time.
Gonna say her
Lots
name,
of birthdays.
Yeah, birthday. Yeah. It's the weather is cooled, so it's nice to be here. This is my first.
It got really cool.
My first fall in the Phoenix metro area.
Which is why you brought your jacket. He has a jacket.
Yeah. Just in case.
Just in case you needed to know that.
Yeah.
Thanks again for listening to the fourth quarter Manage the Funds podcast. Again, I'm Michael Carlin. Stefan, as always.
Yeah.
Thank you.
Wonderful.
It's awesome. Yeah, stay tuned because we will be bringing you exciting new podcasts coming up soon. Make sure to sign up for our latest releases. That's it for now. Take care and have a great day. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities. Member of FINRA and SIPC.